any limiting belief that you have, and how were you able to overcome it to get to your to this deal right now?
Yeah, go ahead and take that one first, Brian.
Man, there's a long list, at least personally, of things as far as the limiting beliefs that I had. I would say the biggest one, I think that's the biggest hurdle for most people, is going to have to do with the zeros. You look at some of these transactions, and this is not a single family house. It's going to cost you 150,000. This might be a million, 10 million, 15, 20 million. This last acquisition of ours was over 18 million. So you can't let the zeros and the numbers really scare you. You can't have that limiting mindset that, I'm trying to buy a $20 million deal. I need 20% down. I need to have that in my pocket. Otherwise, I can't do it. Multifamily is a team sport. And unless you can sort of, shift your mindset and crush that limiting belief that you need to do everything on your own, not only from a capital standpoint, but from a time and effort standpoint, then you're going to have a hard time. So I would say that was probably my biggest belief. Limiting belief at first was just I didn't have enough capital to do these size deals.
Yeah, I would echo that, Brian. I mean, before getting into multifamily, part of the reservation in making that big transition was, I didn't have liquidity, I didn't have net worth. And, those are all very important things that you need in this space. But what I didn't realize is you can go partner with people to find it and build a team around you to do that. But even after making the transition to multifamily, I started looking at smaller assets, 10, 20, 30 units, because I thought that was going to be an easier property to manage, at least on paper, right? And so very similar to what Brian just said is like, you look at the numbers and you're like, man, how am I going to go manage a 10, $20 million asset? Well, what took me a little bit to realize is that as the deals get a little bit larger, things get a little bit easier. And as you continue to build your network and you build your team, those larger assets then become more of a possibility and reality. And so, crushing that limiting belief was just absolutely game changing for myself personally, and I think for our business. And as Brian alluded to, now we're part of this $18 million deal with a great lead sponsor, and
Welcome everyone to the Multifamily Deal Structuring Monday, where we will discuss about the apartment deal that our guests have closed in the past. Don't forget to hit that subscribe button and the bell icon so you get notified whenever a new episode is released. Our guest for today is Cody and Brian. So Cody and Brian are managing partners of Blue Oak Capital. Blue Oak Capital is a Houston-based private equity firm with an exclusive focus on the acquisition of workforce, B and C, multifamily communities across Texas, Tennessee, and Kansas City. Cody is the head of deal acquisitions and has been active real estate investor for over 10 years. Brian is the head of investor relations of Blue Oak Capital, carrying a background in food service operations as a multi-location retail business owner. Brian's real estate experience spans across both residential and commercial real estate. Cody and Brian now retains ownership interest in a 240 multifamily units as a general partner. So here's the episode. Hi, Cody, and hi, Brian. Welcome to the Multifamily Deal Structuring Monday, where we will be discussing all about your multifamily transaction. Welcome here in the show.
excited to be here, Jeff. Thank you so much for having us.
Yeah, Jeff, thanks for having us. Appreciate the opportunity.
Yes, for sure. Then, let's start with that. Tell us about yourself.
Go ahead, Brian.
Sure, yeah. Well, thanks again for having us on the podcast. A little bit about me. I got into real estate about 3 years ago, I would say. Like a lot of people, started in the single family space, did that for about 18 months, and very quickly realized that in order to scale and to go bigger and to build a business, multifamily was the avenue that was for me, best aligned for my interests, short-term and long-term goals, and also my personality, which I think is really important for people to consider when they're looking at different asset classes, is how much time can you invest in this? What really aligns with your personality and your skill set? So I would say early 2020, decided to make a pivot into full-time real estate. I'm very fortunate, met one of our partners, John Beatty, who's not with us here today, but I met John Beatty, obviously met Cody. They had just formed Blue Oak not too long before I joined. And I guess you can say the rest is history. We met, we had a great connection, great relationship. They felt like I was a good value add to the team that they had just formed. So I joined them over at Blue Oak, and here we are closing deals.
Yep.
Absolutely. Very similar to Brian, I came from a single family background. My investing career started about 10 years ago after becoming an accidental landlord in 2010. And around that time, my wife and I bought a second home, but couldn't sell the first. And all we knew is we couldn't afford to pay two mortgages, stuck a tenant in there and said, we'll figure it out later. And I was like, hey, this is pretty cool. Somebody's in my house paying my mortgage, and I don't have to worry about it. But along the way, read Rich Dad, Poor Dad, and a light bulb went off. I was just starting my W-2 career a couple years prior, and my original goal was to go up the corporate ladder, so to speak, in my industry. And after reading Rich Dad, Poor Dad, realized that all of my teachings growing up and all the emphasis on education and being a W-2 employee was completely wrong for me and what I had envisioned for my long-term wealth and financial independence. And so fast forward 10 years, tried a couple different business ventures, both real estate and non-real estate related, and ultimately just discovered that, the single family space just really wasn't a scalable model that fit my investing thesis. And so made the transition to multifamily in 2019, just started kind of building a footprint for a business, and along the way met John through a mutual connection. And, we launched our company, Blew Up Capital. And through that and through continuing to network, met Brian. And, as he mentioned, just kind of found very good complementary skill sets that Brian brought to our partnership. And, here we are now, like you said, making big things happen. So, yeah.
Okay, that's really nice. So where are you both currently located?
We are both in good old Houston, Texas. Actually, all three of us, John as well. So,
yeah.
Then, like any limiting belief that you have, and how were you able to overcome it to get to your to this deal right now?
Yeah, go ahead and take that one first, Brian.
Man, there's a long list, at least personally, of things as far as the limiting beliefs that I had. I would say the biggest one, I think that's the biggest hurdle for most people, is going to have to do with the zeros. You look at some of these transactions and, this is not a single family house. It's going to cost you 150,000. This might be a million, 10 million, 15, 20 million. This last acquisition of ours was over 18 million. So you can't let the zeros and the numbers really scare you. You can't have that limiting mindset that, I'm trying to buy a $20 million deal. I need 20% down. I need to have that in my pocket. Otherwise I can't do it. Multifamily is a team sport. And unless you can sort of, shift your mindset and crush that limiting belief that you need to do everything on your own, not only from a capital standpoint, but from a time and effort standpoint, then you're going to have a hard time. So I would say that was probably my biggest belief. Limiting belief at first was just I didn't have enough capital to do these size deals.
Yeah, I would echo that, Brian. I mean, before getting into multifamily, part of the reservation and making that big transition was, I didn't have liquidity, I didn't have net worth. And, those are all very important things that you need in this space. But what I didn't realize is you can go partner with people to find it and build a team around you to do that. But even after making the transition to multifamily, I started looking at smaller assets, 10, 20, 30 units, because I thought that was going to be an easier property to manage, at least on paper, right? And so very similar to what Brian just said is like, you look at the numbers and you're like, man, how am I going to go manage a $10, $20 million asset? Well, what took me a little bit to realize is that as the deals get a little bit larger, things get a little bit easier. And as you continue to build your network and you build your team, those larger assets then become more of a possibility and reality. And so, crushing that limiting belief was just absolutely game changing for myself personally, and I think for our business. And as Brian alluded to, now we're part of this $18 million deal with a great lead sponsor, and and hopefully this is opening the doors for many more opportunities like the such. So,
okay, yeah, nice. Okay, so let's jump into this deal. What's the source of this deal?
Yeah, so the backstory on this one actually, started probably about almost 2 years ago through networking and relationship building. So for this particular deal, we are not the lead sponsors on this. We're actually coming in as co-sponsors on the deal. Our lead sponsor is Elevate Commercial Investment Group, Mr. Jorge Brew and his team. And, we met Jorge back in 2019 at a networking event. And from there, just kind of continue to follow him and connecting with him through various platforms and avenues. We actually had him on our podcast and, really just kind of saw his momentum and his growth in the target markets we were in, and was really just impressed with the volume and the scale that he was moving at. And earlier in this year of 2021, we were working on a larger deal ourselves, and we knew we were going to need a substantial help and bench strength to kind of take this larger deal down. And so we approached Jorge and his team about helping us on this. And long story short, that deal did not pan out, but it did open the door for a possibility to partner on future opportunities. And, again, George moving with the momentum that he did, this was, oh man, one of 3 or 4 deals he had under contract just in our market alone. And he had already had 1,200 existing units under his management in Houston. So, when we got to reconvene with him somewhere near the end of Q1, we asked for an opportunity to be able to align with him and partner with him again. And he had this opportunity, and it just seemed to be a really good fit for us. So long-winded answer to your question, I apologize. But basically the source of this deal came through one of the other co-sponsors as well, one of the other general partners, with our friend from Care Ventures Capital, Mr. Saji. And it was an off-market deal from one of the local brokers here in the market.
Okay. Then this is in Houston, Texas.
Yes. Yep.
Then how many units is it?
240.
240. Okay. Then the class of properties, B or C?
Go ahead, Brian.
I would definitely say it's a C-class property. It's in an area called Inwood, which is in North Houston. It's one of those, like Cody mentioned, value-add mom-and-pop properties. It's a 1979 vintage, and it hasn't been touched in a very, very long time. So it's definitely a C-class property that hopefully we can reposition into that, C plus kind of B minus property.
Okay, that's nice. Then regarding the T12 and rent roll, like, was there anything that stood out when you were also checking the?
Besides the extremely low rent, I'll let Cody check that.
Yeah, that's exactly what I was going to highlight, is the fact that, as Brian mentioned, this was a long-term owner. This current seller had the property for 25 years and, was in a position where he was just really benefiting off the cash flow more so than any type of real forced depreciation. And so, he kept the occupancy very high, and in order to do that, kept the rents very low. And so I think one of the surprising things was just the average rent across this 240 unit was about $550 per door. Wow. Which is substantially low, very little other income that was being captured. And so the immediate shock was, man, there is a huge value add potential here, given just such the low potential income that has captured already. So.
Yeah, that's really good. Like, that's really low, at least in Houston, in that market. No need to kind of worry about the value add and then getting the bump up, because it's already at the low price.
Yeah, well, one of the unfortunate things about an asset like this is because of the management and operations from the current seller, he hadn't given the property very much love. And so this is a property that had been, I would not say disregarded, but definitely had not been attended to quite the level of the market standard, right? And so there's a lot of deferred maintenance that needs to be cured, a lot of renovation, cosmetic upgrades as such that needs to be in place in order to really reposition this asset to that good quality market standard that the residents expect. So.
Mm-hmm. So what was the original asking price on this property?
That's a good question. To be honest with you, I'm not sure that I know where the original price was falling. I think it was maybe north of, I think it was a little bit north of where we actually ended up acquiring it for, but we ended up settling at 18.6 million, which equated to about 77 a door, which for a C-class asset right now in the Houston market is pretty low cost basis, all things considered. So.
Okay. So at least you're able to get it around 18.6, right? And
yes.
Yeah. Then what's the economic occupancy of the property when you bought it?
Existing, actually, that was another thing surprising. It was actually less than 10% overall. Yeah, it was, again, the owner had kept it above 95% occupancy for a while now. But because the rents were so low, loss to lease bad debt wasn't really an issue. The economic losses weren't really an issue because, he was just cashing in these very low rental incomes every month. So, yeah.
Okay. Then, yeah, how is the financing breakdown looks like for this? Like, was this like a Fannie, Freddie, or for the,
Yeah, this is a bridge loan. So this is pretty standard when you're looking at a deal like this, an asset like this that needs so much, I would call love and attention. The CapEx budget is about 15K a door, which is, we've seen bigger, but it's not a light value add. It's definitely a little bit bigger. They have a bridge term on this one. And so that was a strategy that obviously makes the most sense for this type of asset.
okay. Then what is it, like a 75 or LTV or loan to cost, I guess, on this one?
Yeah. So go ahead, Brian.
I was gonna say this one's 80 if I'm not mistaken.
Yeah, it's an 80% loan to cost, 2-year term with a 1-year extension, all IO. Pretty attractive rate when we came out the gate at 4.15%, which if anybody's been in the market for some time, I mean, 2 years ago, bridge debt was quoting you at about 8%. And so, to talk about bridge at a 4% interest is really attractive. And one of the benefits of utilizing bridge right now in today's market is bridge after COVID came out very, very aggressive in their terms. And so for a while, actually, I would argue probably Q1 and most of Q2 so far, we've seen bridge become kind of the market leader, so to speak, on the debt side, just because of the aggressiveness of the terms. And the other benefit of that is you can roll in your CapEx costs into the loan and whatnot, and you don't have all of the reserve requirements that the agencies will require you to put up. So, but there is some execution risk that comes along with bridge debt. You have to be careful which bridge lenders you go with. But yeah, we had a pretty attractive term sheet, I would argue, on this one.
Yeah, 4% is really good, like at least for a bridge. And also, so there's no, as you said, like there's no reserve required, right? Like for this, nothing.
Correct. Yeah. There's no COVID reserve requirements like we've seen with the agencies or anything like that. So, which, from an operator standpoint, that's a reduction of capital that you don't have to go raise, right? And that's the challenging part with agencies is when you do have to go raise that additional capital to cover those reserves, or even the CapEx that you may not be able to roll into the loan. Your CapEx goes from what, Brian, we raised 5.6 in total, 6 million on this one. It would have been much higher than that if we'd had to gone a different route. So.
Okay. Yeah, definitely. Like, because I think that reserves also hurt it's kind of reduces all these returns to the investors. That's why it's hard. Yeah.
That's right.
Yep. Then, well, how does the structure looks like for this? Was this like a straight split, or was there a preferred return?
Yeah, this one's a straight 70-30 split. So no pref on this one, which we were a fan of. We like personally very simple capital stacks that don't have tons of waterfalls and things that are very confusing. So this one's just a straight equity split.
Okay. Yeah, sounds good. Then, for the business plan, like, are you planning to hold it or eventually like sell it after 5-6 years? What's your business plan?
Yeah, so the business plan is a 5-year hold. Obviously, with the bridge debt, again, that's going to be a total of a 3-year term if we execute that 1-year extension. So we do have to either exit or refinance by the end of year 3. So the plan is right now is to execute that refinance in year 3 and then continue to hold for another 2 years or so.
Okay. Then how does the IRR or the average cash on cash looks like for this?
The cash on cash looks like it's a typo, right, Cody?
That's right. When we first put this deal out there, man, we got a lot of remarks like, "Hey, I think you made an error on your marketing," and we're like, "Nope, those are real targeted projections." So, but Brian, you want to allude to a little bit more about what those returns look like?
Yeah. So the cash on cash on this one is 18% on the conservative end, all the way up to 20%. And that's obviously risk adjusted. This is a heavy value add asset. Like I was mentioning, that's about 15K a door, right? So you're going to definitely see those higher and more attractive returns. Equity multiple, you're looking at a 2x multiple on the deal, if not a hair over. And the cash on cash is around 22% annualized. So overall, very, very attractive deal from a numbers standpoint. But it is a ton of work, so that those numbers definitely reflect that amount of work that's needed.
Okay. Yeah. Thanks. Then for the next segment of the show, so we'll discuss about the due diligence about this. So if you can explain like what kind of due diligence that was done on this purchase.
Yeah, so the due diligence is very robust, and when you're looking at these apartment deals, right? And it goes everything from looking at the physical characteristics and quality of the asset, all the way down to the actual business operational due diligence, right? And so for the physical due diligence, you want to look at obviously your big ticket CapEx items, your roofs, your foundations, your plumbing, electrical, HVAC systems. And then you go a little bit deeper into detail. You want to make sure that you're touring every single unit, walking every unit, looking for any signs other than just your general cosmetic upgrades, what can be salvaged, what needs to be replaced, and things like that. You want to look at your exteriors, the conditioning of the exterior walls, if they need to be repainted, things like windows, landscaping, signage, laundry, if you have laundry on site. All of those things come into play when you talk about the physical due diligence of the property. But then from the business side, you got to look at everything from accounts receivables, leasing contracts, leasing terms, vendor contracts, that are in place. Basically, what you're doing is you're trying to make sure that what's reflected on the profit and loss is what's actually flowing in and out of the business, right? And so all of those contracts, all of those expenses and income collected has to be double verified. Bank statements, tax statements, anything else, you name it. What else, Brian? Did I miss anything there?
No, man, it's definitely a thorough process. And then, that counts all the actual physical due diligence, everything from, inspecting your plumbing, your electrical, your roofs. And that's Jorge's really his bread and butter. He likes these heavy value add deals, and he has a in-house construction team and an in-house due diligence team, which he actually offers that as a third-party service to other operators, other investors as well. So he's very, he has all the software, all the technology, and the systems in place to go through the actual cosmetic and the physical aspects of due diligence.
Mm-hmm. Yeah. I see like Jorge in a lot of his Facebook posts are doing a lot of tons of due diligence. I think at some point too, like he was doing like 3 or 4 deals in one time. Doing due
Yeah,
diligence. Flying.
he's moving with a lot of momentum, which is really exciting to watch and see and actually be able to be involved with and whatnot. So he's definitely got a great system, great construction team behind him. Yeah, he can move quite a bit. So
Yeah. Oh yeah, by the way, like for this deal, so Jorge, I guess, will be taking care of the construction side of the. Then is there will be a separate property management company, right? Or is it all together with Jorge, like both construction and property management?
yeah, no, he doesn't have property management in-house, so it is third party. And so our property management team that we've identified for this one is one of our actually preferred property managers we've worked with for some time now, Asset Living, that has a massive portfolio under their management, over 100,000 units across multiple different markets here along the Southeast region. And so that is a huge value add for us, because not only do they have the economies of scale, but they have the resources and proof of concept in the select markets that we're in, Houston in particular, several thousand units under their management. So definitely helps to be in proximity when you have a property management team that has such a large portfolio.
Yeah, and also I think this one is good. Like if you have a separate property and a separate construction, because they will be focused mainly like on their own lanes.
Sure.
Construction will be much faster because they're just focusing on really flipping the units, while the property is like filling up the units.
Yep.
Yeah, you're right. And I think for anybody looking to, whether you take your business in-house with property management or construction, or your third party, you really want to treat your vendors as if they're partners in the deal, right? So you want to make sure you have great working relationships with, in this case, like our property management team, George, and he has his construction team, like you said, under his management, and he's able to control that side of it, but really partnering with the property management team to make sure we execute the CapEx plan in a timely manner without delays and without barriers. And so having them involved from the beginning, from the CapEx planning and business implementation is really, really important.
Yep. Yeah, then that's very good. Okay, then the next segment will be the capital raise, which I think you already touched base. You need to raise 5.6, right, for this deal.
That's right.
Okay. Then do you recall like how many investors you ended up with on this?
In total, it wasn't a lot. I think we landed probably, what, Brian? I don't know, maybe 25, 30, I think in total.
Yeah.
Something around that. I think for us, Brian, John, and ourselves from Blue Oak Capital, we had committed about $1.5 million to the deal. We actually landed at 1.1, and we can kind of talk through that a little bit. But and the 1.1 that we brought was amongst, I don't know, what,
a dozen or so?
Yeah, probably a dozen, 15 investors, I think. So
yeah.
Okay. Yeah. Oh, that's good. Then how long did it take, like, for the whole capital raise?
What, 2 months?
45 to 60 days.
Yeah, 45 days.
Yeah.
Okay.
Yeah. What was interesting is, like, the one challenge in today's marketplace is that there's so much liquidity on the sidelines, and the deals have been the challenge, right? Finding deals. And what was interesting, I feel like one of the contributing factors in our deal in particular was, at the time of this deal coming to under contract, there was all of a sudden this rush of deals to the market. We've seen this massive deals on the market in Houston in particular. And so all of a sudden, all that same liquidity that was looking in this market, everybody was kind of competing for. And let's be honest, I mean, not everybody has an appetite for, these deep value add projects. I mean, the targeted returns are very, very attractive. But as Brian said, there's a lot of execution risk that comes with that. So high risk, high reward, right? And that may not fit everybody's appetite. So, yeah, it took us about 45 days, but I think overall, I don't know, Brian, what would you say? I think it's been a pretty good raise, pretty good experience so far.
Absolutely. Yep. I agree 100%.
Yeah. I think that's the key. It's like the crucial point of this heavy value add is like having the right construction team. But I think Jorge is in your team, so I think you will be in good hands. Because sometimes, like some investors, like if they use like a third party and never knew them, right? Or it will be kind of risky.
Well, to that point, and I think Brian would probably agree with this, for us at Blue Oak Capital, this would be a type of deal that we probably would normally steer away from, just because of the deep value add component. With George and his experience in the construction background, having that vertically integrated construction company in house, again, this is his bread and butter. This is what he does day in and day out. So when you see a $3.8 million CapEx budget, for somebody like that, it doesn't really faze him. Whereas for us, we might be like, hey, that might be too big of an undertaking. So having that experience and the bench strength of our team definitely gave us a lot of reassurance and confidence moving forward with this one.
Yeah. Okay, so second to the last segment is regarding the closing. Do you recall like how much, like roughly, was the closing cost on this deal?
Not off the top of my head.
Yeah, no. So we're actually closing. I don't know when this episode is going to air for you, but we're actually closing May 25th, and at today's recording, this is May 20th. Yeah. So we're about 5 days out from close, but I think it was about 800,000, if I'm not mistaken, somewhere in that ballpark, 850,000. And it ended up being about 3 to 4% of the total project costs.
How long did it take, like from either LOI or contract to the May 25th? When did it start, like this deal?
Late January. I think late January is when they got it under contract, and then so it's probably start to finish. We're looking at around about 90 days or so.
Okay, so I always ask my guest these final five sizzling questions. So any lessons learned? So number one is any lessons learned that you want to share, like from deal analysis, due diligence, capital raise, etc. Yeah.
Oh man, I would say there's a long laundry list of stuff that we've learned, and we're looking forward to continuing to work on this project and learning as well from Jorge and his experience. But for us, one of the biggest learning lessons has been just taking what we've learned and what we've been practicing for the last 12 to 18 months on nurturing your investors and making sure you're building that, what is it Dan Hanford says, the KLT, right? Know, like, and trust. So really making sure that people know us, that they like us, and they trust us, so that when an opportunity presents itself, whether it's a 506B or a 506C, whether it's a stabilized, steady cash flow play, or it's a heavy value add play, that we have enough investors in our network and our database to be able to contribute to any type of equity raise, and just be able to add value to other experienced sponsors. So that's definitely been the learning curve, I would say, at least on my end. It's just getting investors over the finish line, letting them know why we like this deal, and just building that trust with them and that relationship, so that we can do deals with them long term.
Yeah. I would echo that, Brian, and I would also piggyback on the fact that when you're raising capital and you're trying to get money wired and funds into the actual account, you have to create that sense of scarcity from the very beginning of the project, and you really have to stay on top of your investors, not in a way that's pestering, but in a way that, again, just kind of sets the boundaries and expectation of, hey guys, listen, this is a great opportunity, and we're going to fill it pretty quickly. So we're going to need to make sure that we get you in and get your funds wired, so that way we're not scrambling at the last minute, or you don't miss out on an investment opportunity as spots continue to fill up. And I think that was one thing that we learned, as we were so focused on, just getting soft commits in, and we spent a lot of time, I would argue, Brian, over probably last several weeks of going back and collecting things like PPM, making sure the PPMs were signed, making sure that the wiring instructions were filled out correctly, or wired correctly. Man, what was the other one? Accredited investor verifications, things like that. All those little knickknack, tedious, really paperwork that you have to do for these type of projects. I feel like that we spent a lot of time kind of cleaning that up. Whereas if we would have kind of probably set a more expectation in the beginning, we could have saved ourselves a little time there. But when you're dealing with these high net worth individuals, they're all either highly paid professionals, doctors, lawyers, engineers. Their time is very scarce, so you have to take advantage of the time that you have with them when you can, and make sure that they do what they're supposed to do on their end. So.
Yeah, I guess that one is also important. Like, especially you need to know your investors, because we also experience this. Like, yeah, you will have soft commits, but you need to also know the status of your investors, because if you don't know if you will have a deal that you're partnering, either it will be 506B versus 506C. Maybe most of your investors were 506B, so you need to know also like which deal you can really partner with. So that's, I guess, to anyone who's raising capital, that's crucial upfront also to know ahead of time. Are they on the 506B bucket or 506C? So you will know how much capital you can raise if you have a deal coming to your table for 506B versus B or C.
Yeah, and I agree. And I think, listen, you can have a whole nother segment or series on building out your investor database and really understanding the dynamics of raising capital. And as Brian mentioned, I mean, it's taken us 18 months, 2 years to really put together our framework to go out and take on a project like this with the sponsorship team that we're part of. But yeah, you're absolutely right. If you don't know who your investor database is and what their investing appetite is, you're going to have a lot of trouble raising capital. And if you're looking to raise a significant amount of capital, multiple millions of dollars, it's a numbers game. You have to have a big database. You have to have a big network. So, just having a handful of investors is not going to get you very far. So always continue to expand your database, always continue to network, and really build on those relationships, as Brian mentioned earlier.
Yep, 100% agree. Yeah, so the second question is any recommended books?
What you got, Brian?
A lot of good books out there. I mean, for anybody looking to get started, I would say, especially in multifamily, if you're looking to follow a syndication route, I think everybody I know in our circle has read Joe Fairless's book, the best ever, best ever real estate book for syndication. So that would definitely be a good place to sort of, it's a big book. It's 300 or 400 pages, so it can take you some time, but there's a lot of great content in there. And then, Cody, I won't steal your other one, but there's a really good capital raising book as well. I'll let you take that one.
No, man, go ahead. Go ahead.
Oh, I was going to say, everybody knows Hunter Thompson, right? So
Yeah.
he's got a great book on attracting capital, raising capital. And I can tell you that a lot of the successful operators out there, including a lot of most of the stuff that we follow, is just really following the script that's been laid, in front of us. We've heard it on our podcast and other podcasts, success leaves clues. So, there's no need to reinvent the wheel. We're just, taking this content, taking this information that is in these mediums, is in these books, listening to their podcasts, going to their training events, their virtual meetups, and just applying what they're teaching, and it works. It clearly does.
Yep. So
I have nothing to add, man. I'll just echo Brian.
yeah. So the number 3 is like any recommended podcast or YouTube channel that you're listening or watching.
Hashtag real estate Cody.
I was going to say the Prosperity Through Multifamily Real Estate Investing podcast is a really good one. I don't know, pretty good guest, our host there, but yeah, we have a great podcast show where we've been able to speak with a lot of industry leaders and just really enjoy the podcast medium, and I think it's a great education forum. So definitely check out ours. Again, that's the Prosperity Through Multifamily Real Estate Investing podcast. I would definitely recommend guys like Whitney Sewell and the Whitney Sewell, let's see, Hunter Thompson, Cashflow Connections podcast is great. Dan Hanford and the Multifamily Investor Nation. Man, I think the laundry list can go on and on. There's so many good podcasts out there. Our friend Abel Pacheco has a great show, the 5T Real Estate Podcast. I don't know, Brian, can you think of any others?
There's a lot. I don't want to mention and then miss somebody.
I know. I'm going to get some slack because I know I missed several.
Yeah. Okay. Yeah, I'll put that in the shows. Then can you repeat so your podcast, Prosperity 2?
Yeah. I know it's a long title. Prosperity Through Multifamily Real Estate Investing Podcast. Yep.
Okay. Yeah, I'll put that in the show notes. At least all this podcast and link. Yep.
Thank you.
And then number 4, this is the time to promote yourself. What's your acquisition criteria for multifamily?
Our acquisition criteria?
Yeah. So if you're someone has a deal that they want to partner with you guys, then yeah, what area is there? In any area that you're looking or classes? Yeah.
Sure. So our focus is primarily on the workforce housing space, the B minus C plus space. In the primary and secondary markets across Texas, Tennessee, Kansas City. We prefer apartment syndication. So we're typically looking at deal sizes that range, 75 to 200 units, but we're also open to joint venture structures as well. And, listen, if the deal makes sense, it doesn't matter how big it is. If it makes sense, then we will obviously take a look at that. But we prefer more of a blend between both forced depreciation, the light value add component, and some equity gain on the back end, but with good cash flow. So, more probably of your stabilized assets that can qualify for, stabilized agency debt, whether it be fixed or floating. But we're not opposed to a value add opportunity as well if it's with the right team. So, anything we missed there, Brian? I think that's about it.
80s vintage, kind of standard stuff.
Yes.
Prefer no flat roofs if possible. But again, it's sort of deal specific. We find a nice value, a nice, well taken care of asset that's had all the plumbing and electrical updated. Then we're more than happy to still take a look.
Mm-hmm. Yep. How about chiller boiler? I know this has been, some people are going away.
Yeah, it's a tough one. I think I would say it's deal specific. I try not to look at each individual aspect or criteria of the deal and make a decision on that. I think it just depends on the overall deal itself. So our deal that we're part of now, it does have boilers on site, but that's everything else as far as the other characteristics kind of check all of our boxes. So I would definitely say it's deal specific. If it's a deal that has flat roofs, boilers, chillers, 1965 vintage, that's probably not going to be the one that fits our appetite. But yeah.
Okay. Yeah. So the last question is, what's the best way to contact you guys?
Go ahead, Brian.
Yeah, we're pretty easy to find, or at least that's what people tell me. You can definitely find both of us on LinkedIn. We're both pretty active. Look up Cody Laughlin, Brian Alfaro. You can also just search Blue Oak Capital, and you'll be able to find me, Cody, and John on there as well. We also have a meetup, both virtual and in person. So if you so happen to be in the Houston, Texas area, we're willing to drive or fly. We do have a meetup, the in-person one. Correct me if I'm wrong, Cody. The last Thursday of the month, usually.
Second Thursday of every month.
Second Thursday of the month.
The virtual's the last, yeah.
There we go. Got it backwards. And virtual's last Thursday. So I would encourage you to check out our website, www.blueoakinvest with an S at the end.com, and just join, subscribe, sign up on there. You'll get our newsletter. You'll get our updates on our podcast. You'll also get our updates on our meetup. And just don't be afraid to reach out. You can reach both of us by email as well, Cody or Brian at blueoakinvest.com. And we're happy to answer any questions or schedule any calls, and just get out there and network with other high caliber people.
Yep, perfect. Yeah, so I'll put the contact information in the website, also in the show notes. So for everyone who wants to reach out to Cody or Brian, yeah, feel free to reach out to them.
And
So,
John's cell phone number is 3. No, that'll be his punishment for not being here.
I know, right? But good luck getting him on the phone. I mean, we have a hard enough time getting him right.
yeah, for sure. Okay, so we reached the end of the show. Thank you for love having you guys here in the show. Thank you for coming over.
Thank you for having us, Jeff. It's been a pleasure, man. Really appreciate it.
Okay.
Appreciate it.
All right, thanks.